everyone, welcome back to EduTap and welcome to Finance Current Affairs session. In today's session, we are going to discuss two very important news articles in finance. The first news article is regarding a concept that is the additional tier 1 bonds. So this is a concept that is quite in news recently and the case against the Yes Bank that is quite in news recently. So we have to understand the background of this case, that how this case started and what is this concept of additional tier 1 bonds. So let's have the clear understanding of this news article, and the second news article is regarding the new bank locker rules. The RBI has extended the deadline. So in today's session, let's understand that what is this extension of deadline that is done by the RBI and why there was a need for this extension in deadline and what are the new bank locker rules. So direct question can be asked from this kind of news article, and it is very important for you to understand, as well as it is very important for you to have the clear understanding of this news article also. So let's start with this important session. But before starting with this session, there is a big announcement for you all, that is the EduTap has brought for you the comprehensive guide for RBI, NABARD and SEBI. So through a single guidebook, you can get all your common queries answered. If you want to know about the examination, that what is the pattern for the examination, what are the previous year cutoff for the examination, and what is the syllabus for the examination. All of these common queries can be answered through a single guidebook and you will get definitive answers provided in this guidebook. Even if you want to know about the preparation for the exam, that is, what should be the strategy for the preparation, what should be the sources for the preparation. So all of this is provided in this single guidebook that you can easily get. Okay, you do not have to visit different links, you do not have to visit different websites to get the definitive answers of your common queries. You can easily download these guidebooks that are absolutely free of cost to save your time, to save your effort, and these are easily downloadable. You can directly click on the link that is given in the description box below and you can download these guidebooks. Okay, so do download these guidebooks. Now starting with our first news article, that is the court order on the Yes Bank AT1 bonds. So before understanding this the court order, you need to understand the background, that was what was going on with the Yes Bank, that the court has to be involved. Okay, so now the Yes Bank saw a significant spike in its non-performing assets. So the non-performing assets of the Yes Bank was increasing. There was shrinking deposits that was happening with the Yes Bank between September 2019 and March 2020. There was much speculation that was going on in the market that the Yes Bank is going to go down very bad and the depositors' money is going to be, the depositors are going to lose the money. So the depositors were also very worried because of course the DICGC is ensuring the deposits of the depositors, but there is a limit set by the DICGC. Above that limit, the DICGC does not insure the depositors' money. So the depositors were getting very anxious that if the Yes Bank go down, what will happen to us? Okay. So now the RBI decided to intervene before the financials went further downhill. Okay, so the RBI decided to take many steps, and the first step was to change the complete administration, to change the complete board of the Yes Bank, and then the RBI placed restrictions on the depositors withdrawing their money from March 5th, 2020, because if all the depositors came to Yes Bank asking for the money, of course the Yes Bank will not be able to pay all the depositors at one time. Okay, there are limited capital buffers that are kept by the Yes Bank. So that's why, to stop that kind of situation and to stop that kind of anxious environment, the RBI put the limit on the depositors withdrawing their money. Okay, so now the RBI also decided that the bank's AT1 bonds obligation were to be permanently written off. So the RBI decided that the bank's AT1 bond obligations, that is additional tier 1 bond obligations, were to be permanently gone. Now the bank do not have to pay back the obligation to pay back the AT1 bond amount. That is, at that time, rupees 8,415 crores of the AT1 bonds were nullified. Okay, so the Yes Bank does not have to pay this much of the amount to the investors that has invested in the AT1 bond. So you can understand that this kind of situation came in front of the bank. It was good for the bank, but the investors were not getting their money back that they have invested in the AT1 bonds. So we will understand this AT1 bonds. We will understand better that what is this written off means and how RBI can do this. But before starting with this, let's have the clarity about the AT1 bond. So see, the Basel III norms, as per the Basel III norms in India, the banks have to keep some capital, okay? That is, the RBI has mandated the banks to keep the capital. So the capital adequacy ratio or the capital to risk weighted asset ratio is 9%. So the banks have to keep the adequate capital with themselves as per their risk weighted assets. So the banks have to keep the capital as per their risk weighted assets or against their risk weighted assets, and it is 9% of their total risk weighted assets. So now here you can see the total capital adequacy. If your risk weighted assets are 100 crore, you have to keep 9% of this 100 crores as the capital adequacy. So you have to keep 9 crore, that is the bank has to keep 9 crore with itself. Now this is divided. The capital adequacy ratio is divided into two types of capital. There is the tier 1 capital and there is the tier 2 capital. So now in the tier 1 capital, there is the common equity tier 1 and there is the additional tier 1 bonds. So here you can see that where this additional tier 1 bonds are, they are under the tier 1 capital. Now what is the tier 1 capital? That is the core capital of the bank. This is the capital of the bank that is on the going concern basis. That is, if any concern, if on the ongoing basis the concern is coming, the distress is coming on the bank, then bank can use this capital buffer to get out of this distress situation. And tier 2 capital is known as the gone concern case, that if the bank is a gone case, now the bank is going to shut down, we all know. So this is the capital that is used to pay back the lenders, to pay back the bondholders, to pay back the investors in the bank. So this tier 1 capital is considered as the most important capital because the banks have to be saved, right? So the tier 1 capital is used to save the bank on the ongoing basis. To get the bank out of the distress situation, the tier 1 capital is used. So this is the tier 1 capital, that is 7% of the risk weighted assets that the bank has to keep with itself. So 7% of the capital, tier 1 capital, the banks have to keep with itself as compared to their risk weighted assets. So this tier 1 capital is the common equity tier 1 capital, where there are the undistributed reserves, that is the profits that are coming to them which is not distributed. So that are the profits that the banks are keeping. So those are the undistributed reserves that are kept under the CET1, as well as the issued shares, the ordinary shares that is issued, and from that some capital is coming, some assets are coming, so that is some money is coming, so that is also kept under the CET1. So you can understand that this is the core capital, this is the liquid kind of capital that can be used on the ongoing basis if the distress is coming. Now there are many other parts of CET1 also. Now the tier 1 capital also consists of AT1 bonds. This came in the Basel III norms. Okay, so AT1 bonds are the kind of bonds that can be issued by the banks, and on that bonds the banks are getting the money. So we will understand in depth that what are these AT1 bonds, but they are a part of tier 1 capital. Okay. So now again the percentages, you can see the common equity tier 1 is the most important kind of capital that the bank has to keep, and the percentage is 5.5% plus the capital conservation buffer, that is 2.5%, that is a separate case. So 5.5% the common equity tier 1 has to be kept, the additional tier 1 1.5% has to be kept, and this is how 5.5% plus 1.5% makes the 7% of the tier 1 capital, and the 2% is the tier 2 capital to complete the CRAR of 9%. Okay. Now tier 2 capital is 2%. That is why the total capital ratio is 9%. The capital conservation buffer is 2.5%. That is, this is additional capital that the banks can keep as a buffer. So this is how, when we add the capital conservation buffer, the CRAR becomes 11.5%. So the CRAR becomes 11.5%. For the CRAR to become 11.5%, the 2.5% extra, the capital equity tier 1 is kept. Okay. So I hope you have understood the percentages, how it is divided. The tier 1, if 100 crore is the risk weighted assets, 7% of the tier 1 means 7 crore of the capital has to be kept with the banks. If the risk weighted assets are 100 crore, 2% of the tier 2 has to be kept, that is 2 crore of the capital has to be kept as the tier 2 capital. Okay, so now I hope you have understood the whole division, that how the division is there among the capital that the banks have to keep as the adequate ratio of the risk weighted assets. Now I think we can move forward with understanding the AT1 bonds. So these are the type of bonds that are perpetual debt instrument, that is on the ongoing basis. So we will understand this. The banks use this to augment the tier 1 capital. So this comes under the AT1 bonds, come under the tier 1 capital to complete the tier 1 capital, that is to keep the 7% in that. Thus comply with Basel III norms. These bonds were introduced by the Basel Accord, by the Basel Committee after the global financial crisis to protect the depositors so that the banks have adequate capital. These bonds were introduced by the Basel III norms. Okay, so these bonds are unsecured bonds. First of all, these bonds, there is no collateral that is kept against the bonds. There are no assets that are backing these bonds. So the secured bonds are those bonds. Secured bonds are those bonds which have some assets attached to the bond. So let's say the property of the bank is attached to the security of the bonds. So if the bank is going down, the bank is not able to pay back the money that is with these investors. Okay, the bank is not able to pay back the investors that have invested in the bond of this bank. So the bank has to sell its assets, the bank has to sell its property to pay back the money to the investors that has invested in the bonds. So these are the secured bonds. Unsecured bonds are which have no assets attached with the bonds. So if the bank is going down, the bonds, how the bonds will be paid? Because there is no asset that is attached with these bonds. So these are the unsecured bonds that have perpetual tenure, that is they are unending, they do not carry any maturity date. So that is the meaning of perpetual debt instrument, that is there is no maturity date that is already written on the bond. So like the vanilla corporate bonds are there, in which the maturity date is already specified, that okay, after 2 years this bonds will be mature, the company will be paying or the bank will be paying the money to the bond holders. So here such kind of date is not mentioned, the maturity date is not mentioned. The banks have a call option, that is whenever the bank wants, after a certain period, that is usually after 5 years, if a bank wants, the bank can call back the bond and the bank can pay the bond holders. So banks have a call option that can be used by the banks to buy these bonds back, to take these bonds back from the investors after a certain period. That is, see what happens, that the additional tier 1 bonds, these are the perpetual, without any maturity they are. So the continuous interest has to be paid, right? That every year on 1000 rupees, 100 is the interest that has to be paid. So now the bank is thinking that I do not want to keep on paying this interest, so let's take my bond back. So after a certain period, they can take back their bond, they can take back their the instrument that they have issued, and they can pay back the money of the depositors, sorry, not the bond holders. They can pay the bond holders and they can take back their money. So that is the call option that they can adopt. So now, since these bonds can be written off, see now what is happening, the bank issuing them. So I hope you have understood the basic criteria of AT1 bonds. They are perpetual in nature, they have no maturity date. If the bank wants, after a certain period, the bank can have the call option, that is the bank can buy back the bonds and pay the investors the money for the bond. Okay, so the bank issuing the AT1 bonds has the discretion to either reduce or completely skip their interest payout. So every year the bank has to pay 100 rupees for the bond. But if the bank is in a distress situation, if there is some institutional failure that is happening with the bank, or if the bank is not able to maintain the capital, the bank can skip the interest payment. That is for 1 year, the investors are not going to have any money on the bonds that they have bought. So you can understand that how risky it is. If the bank is making losses or at risk of falling short of capital needs, if the RBI, then they can skip the interest payment. If the RBI believes that the bank is becoming short of capital and it is unviable to operate, or it is having the institutional failure, the RBI can even decide to write off the principal amount also. So the principal amount will go vanish in the air. So the investors that are holding the AT1 bonds, they will lose these bonds because they have been written off. They do not carry any value now. They will not get, the investors will not get any interest. They will not even get their 1,000 rupees back. That was the principal. So these bonds can be written off by the banks, by the Reserve Bank of India, under the directions of the Reserve Bank of India. Okay, so it can be written off by the banks under the direction of the Reserve Bank of India in the event of an institutional failure that is happening, or the capital ratios of the issuer fall below a certain percentage. They are seen as high risk instruments. So you can understand that they are a very high risk instrument. In some years you cannot get interest. In some time it can happen that the RBI thinks that the bank is going under the institutional failure, or the bank is not maintaining the capital. So the write-off can happen of the AT1 bonds. So very risky it is. They offer higher returns. So why you will buy these bonds now? First, they will of course pay high returns to investors, and that's why the investors want to buy this AT1 bonds. But compared with other debt products, these instruments also carry a higher risk. So other debt instruments, they carry less returns and less risk, and this AT1 bonds, they carry high returns and high risk. So these bonds are subordinate to all the other debt and senior only to equity. So what happens that all the other bonds are paid first and then the AT1 bonds are paid, because these AT1 bonds are perpetual in nature. They have no maturity date. So there is not, like the bank can say that we will pay later, or we are not buying our bond back. So AT1 bonds are paid after all the other bonds are paid, and then the equity, that is the shareholders, get their profits. Okay, so first the bonds are paid because some bonds are secured because the assets are attached with these bonds and they have the maturity period. So after the maturity, the bank has to pay. That is the obligation of the bank. Now the AT1 bond has no maturity date, so the bank can not pay this, and last comes the share. In the distress kind of situation, the shareholders cannot get the profits. So this is the priority list of the bank in paying. So the bank first pays the bond holders, then the bank pay the AT1 bond holders, and then the bank pays the shareholders. Okay, so I hope you have understood this. In the terms of profit also, or in the terms of interest also, this is how they are paid. Okay, so now what has happened? I hope you have understood about the AT1 bonds. Now coming to court order on Yes Bank. Okay, so the SEBI investigation found that the Yes Bank officials were guilty of mis-selling. So now there was the rupees 8,415 crore of the AT1 bonds that were written off. But that is under the power of the RBI, and the RBI can write it off, right? Because the RBI is the regulator. So why is there so much scrutiny that is happening? Why the court is getting involved now? So it was because there was the SEBI that probed, and the investigations found that the Yes Bank was doing a kind of fraud, we can say, and the Yes Bank was guilty of mis-selling these bonds to unsuitable investors. So they are high risk bonds, and they were sold under the skin of the secured kind of bonds. So they are quite risky bonds, but they were sold in the perception that they are safe. Okay, so that was happening. So they were sold to unsuitable investors such as the senior citizens, with institutional investors offloading their bonds to retail clients. And the institutional investors, the big investors, they were selling to the retail clients the AT1 bonds. If it found that during the process of selling the AT1 bonds, individual investors were not informed about all the risks that are involved in this AT1 bonds, and they were sold as super FD, that is, it is as safe as FD. So the AT1 bonds was sold under the skin of the safe assets, or under the skin of the safe as FD, and that's why this is a cheating that was done with the investors, especially the small investors that do not have much understanding of the market. And they thought, okay, the Yes Bank is saying that it is as safe as FD, so let's break our FD and let's do the investment in this AT1 bonds. It passed orders, so the SEBI passed orders and imposed penalties on the Yes Bank top executives, but the investors themselves, they banded together, they came together and they challenged the write-off decision in the courts, especially the Bombay High Court has given the decision now. The Bombay High Court has set aside a March 2020 decision by the Reserve Bank of India to write off the rupees 8,415 crore worth of the bank's AT1 bonds as part of the bailout of the private lender. So it was for the bailout or to bring the private lender out of this kind of situation, out of the distress situation that happened in 2020. So to bail out the private lender, the Reserve Bank of India has written off or has ordered to write off the AT1 bonds of this much amount. But now the Bombay High Court is saying that this cannot happen. Okay. So now the restoration of the written off value of the AT1 bonds as per the High Court order may imply a hit of about 8,400 crore or 3% of the Yes Bank's common equity tier 1 capital can go down. So we can understand that the common equity tier 1 capital is going to go down by 3%. That is, the Yes Bank is going to come under a major scrutiny and it is going to come under a major problem, because if the common equity tier 1 capital is going down, that means if any distress situation comes on the Yes Bank, then the Yes Bank will not be able to hold much longer. Okay, and the work that the Yes Bank is doing, it is most suspicious that the Yes Bank will go down as soon as the tier 1 capital will go down. Okay, so now I hope you have understood regarding the additional tier 1 bonds. And see, the bonds in the payment, when any bank or when any company is paying now, so first the payment or first the interest is paid to the safe bond holders, or it is paid to the secured bond holders. Otherwise they will say that give our money back right now, or give our money back, and we want you to sell your assets and give our money back, even if the banks do not have the money. So that's why the bond holders that are secured, or the bond holders that are that have a maturity date, first those bondholders are paid the interest, then the AT1 bondholders are paid the interest, because you can say to AT1 bondholders that we do not have the capital or we are going in losses and we cannot pay. So after these are paid, then the AT1 bondholders are paid, and when at last the equity shareholders or the shareholders are paid at last. Because if you are not paying the AT1 bond holders, that means your capital is down. You cannot even pay the profits also. Of course, the profits should not be happening now. That's why you are saying the AT1 bond holders that we are in a trouble. So that's it. That is the scenario. That is the how first the bond holders are paid. That is the normal bond holders are paid first. Then the AT1 bond holders are paid, and at last the shareholders are paid, or the payment has been made for the profits that is happening to the shareholders. So I hope you have understood this, just to clarify. Okay, so now coming to the next news article, that is regarding the safe deposit or the facilities that is provided by the banks of the safe custody article. So you must have understood or heard about the lockers that the banks keep. So RBI in August 2021, on 18 August 2021, issued revised instructions with respect to the safe deposit locker that the banks are keeping. That inter alia required banks to enter into revised agreements with the existing locker holders. So what happened that in August 2021, the RBI revised the instructions for the lockers. And when the instructions are revised, so of course the new agreements has to be made with the revised instructions. So the RBI specified and the RBI informed all the banks that get into a new locker agreement and get your locker holders, inform your locker holders and get them to get into the new agreement with the banks by January 1st, 2023. So of course you can see that a whole year has been given to the banks to get into the new agreement, or to the locker holders to get into the new agreement with the banks. So it has come to the notice of RBI that a large number of customers are yet to sign the revised agreement or the new agreement and are facing difficulties in doing the same. As well as in many cases, the banks are yet to inform. They have not even informed their locker holders that this kind of revision has happened and we have to sign a new agreement. So customers that about the need to do so before the stipulated date, that is 1 January 2023, and this date has already passed. So what was happening that their lockers, the customers' lockers were getting frozen because they have not gotten into a new agreement with the bank and their lockers were getting frozen. So now the RBI thinking about the many customers that are facing the issues. So the RBI has came with a new kind of date. Okay. So in light of the aforementioned factors, the deadline for the banks is being gradually extended until December 31, 2023. So the deadline has been extended to December 31, 2023. That this much of the time has been given to banks to inform the customers and to get into the new agreements. Okay. So next, banks are advised to notify all their customers of the revised requirements by April 30, 2023. So now the RBI thought that it is not good to leave everything in the hands of the banks. So we have to spoon feed them, that at least first notify the customers by this date. Banks ensure that at least 50% and 75% of their existing customers that have the locker facility, they get into the revised agreements by June 30. That is 50% of the locker holders should have the revised agreement by June 30, 2023, and the 75% of the locker holders that has to get into the revised agreement, that should be done by September 30, 2023. Banks are advised to facilitate the execution of the fresh or supplementary stamped agreements with the customer. So the new agreements has to be signed. So this should be done by arranging stamp papers, or electronic execution should be done, so that it becomes easier for them also to get into the new agreements, and the copy has to be kept of the agreement also. So where operations in lockers have been frozen for non-execution of the agreement, or the revised agreement has not been signed, the lockers were frozen for those. So that has to be unfrozen, because now the date has been extended from January 1, 2023 to December 30, 2023. December 31st, 2023. Okay. So I hope you have understood this news article very clearly. So now let's see what are the revised instructions. So at the time of allotment of the locker to a customer, the bank shall enter into agreement with the customer to whom the locker facility is provided on a paper duly stamped. So this is the first revised instruction. Before the end of the day, banks must send an email and SMS alert to the customers that are registered with their email address and mobile numbers for the confirmation, and if any unauthorized locker access is happening, so that must be notified to the customer, and that will be easily accessed, that the customer will say that it is not me that is trying to get into the locker. So the banks will be eligible to pay in case of any loss that is happening to the locker content resulting from the bank's negligence according to the new RBI standard. So the bank has to pay for any loss that is happening to the locker if the bank is being negligent and there is some loss that is happening to the stuff that the people have kept in the lockers, and the bank have to pay 100%. So the bank's liability shall be for an amount equivalent to 100 times the prevailing annual rent of the safe deposit locker. So the customer that is paying the annual rent for the safe deposit locker, the customer will be paid 100 times if there is any problem that is coming in the locker, if there is any safety issue that is coming in the locker. To ensure prompt payment of the locker rent, the banks are allowed to obtain a term deposit, that is the 3 years fee has already been taken by the banks. Okay, so at the time of the allotment of the locker only, which would cover 3 years rent and the charges for breaking open the locker in case of such eventuality. So you can see that in advance only the payment is being made and taken. Banks, however, shall not insist on such term deposits if the lock holders already have the lockers, existing lockers, and they are paying satisfactorily beforehand. Okay, so that is they have good score, they have like the good credit score now, that the banks the customers are paying back their loans at time. Similarly, the locker holders, they are paying on time, they are taking care of their account very well, so they should not be forced to do the term deposits. Bank shall have the discretion to break open any locker following due procedure if the rent has not been paid by the customer in 3 years in row. Okay, for 3 years if the payment has not been made, so of course you can break open the locker. If the locker remains inoperative, that is no one is coming to see what is in the locker, nobody is coming to operate that locker, so for the period of 7 years, then the stuff that is in the locker, that has to be given to the to the nominees or the legal heir. So what is happening, that the payment is being made for the locker, but nobody is coming to operate that locker, nobody is coming to see the locker. So whatever is inside that locker should be given to the heir, okay, to be given to the nominee, or dispose of the articles in a transparent manner as the case may be. So 3 years, if there is no payment, after 3 years the locker will be opened, and after 7 years if the payment is made but the operation is not happening in the locker, so after 7 years the locker will be opened and the stuff will be given to the nominee, or it will be dissolved, it will be disposed of. So this was all for today's session, the 2 news articles we have done today. This is the first question that I hope you will be easily able to answer, and this is the second question, and here you have to tell about the AT1 bonds. So thank you very much. Do subscribe to our YouTube channel, join our Telegram channel. You will get the PDF of this session in our Telegram channel, and thank you very much. You can mail us here or you can contact us through this number. Thank you very much everyone.